Hello, this is Edmund Shing from BCS Asset Management, and this week we're going to look at how easier financial conditions are boosting stocks. First of all, easier financial conditions are helping risk assets such as stocks. Secondly, in terms of the macro environment, the ISM surveys in the US are bullish. Thirdly, in terms of commodities, we see natural gas very strong on weather as it gets colder. And finally, sectors. In terms of sectors, defensive yield seems to be the place to be invested. Let's start with risk. Here on page 4 you can see that the VIX, the line in blue, is down to nearly, just over 14, so it continues to fall from its peak of 26, although it has not really renormalized. I would consider renormalizing back to a level of about 12. So here, market volatility is still falling, and that is a good backdrop for stocks. Secondly, on page 6, we can see that the financial stress indices, either the Citi Macro Risk Index or the Bank of America Merrill Lynch Financial Stress Index, are both falling, again suggesting that conditions are slowly renormalizing, better for risk assets like stocks. The big driver here is the massive improvement in US financial conditions, which we can see here on page 7, the line in blue. The Fed is unlikely to raise rates until well into 2015, and I think more likely the beginning of 2016. We have also seen bond yields fall back and inflation break-even fall, and all of these things tend to be good for US financial conditions, again good for risk assets. Secondly, the macro. Well, if we look at both the manufacturing ISM index, which is the line in black, and also the non-manufacturing in blue, we can see that, the new orders in blue, we can see that in both cases we saw a big jump in September, which is good news for the economy. In terms of employment in particular, here are the employment components, both of the non-manufacturing index of the services side in black, and on the manufacturing side in blue. Particularly if you look at the black one, which is a much greater part of the US economy, the service sector, employment jumped sharply, so we expect to see good employment gains in the US economy moving forwards. On commodities, thirdly, natural gas, you can see here in black, has rebounded to about $4.2 per British thermal unit, million British thermal units I should say. The oil price has not reacted yet, has continued to fall, but the gas price has already moved up, so that should be good for gas stocks moving forwards. However, in terms of precious metals, gold and silver continue to fall as the US dollar strengthens, so it seems to me that at the moment nobody wants gold or silver. Finally, in terms of sectors, we can see here the line in blue, the healthcare sector, in yellow, the real estate sector, and in black, the utility sector. All three have performed extremely well over the last month or so, and are all three breaking out to new highs. So we can see here that people still want to buy yield, they want to buy defensive sectors, even as the market rallies. And so these are the three places probably safest to stay. In summary then, we can say that US stocks are getting back to the highs, thanks in large part to easier financial conditions. Macro tends to look better for the US with better ISM surveys. Natural gas is making seasonal gains, but clearly no one wants gold at the moment. And finally, in terms of sectors, stay with defensive yields such as utilities, real estate and healthcare. This is Edmund Shing from BCS Asset Management saying goodbye.